There we go. So if you haven't seen this report, whether an investor or a founder, I highly recommend it. So much great information in here. As a founder myself, looking forward to a round. I found it really interesting to see who's investing the most. And I think it's a cool resource. So just on the angel side of things today, the top 5 things to know. The exact number of angels is a mystery, but it definitely is growing. We're going to talk a little bit about the state of angel investing in Australia during this session. Certainly much better in 2021 than it was in 2020. There's a diverse representation. Actually, no, it seems to fall short. So I think there's not enough diversity in angel investing. Again, something we'll talk about today. Quite often, you've got successful professionals and exited startup people as angel investors, which I would highly recommend getting, especially those exited founders in to help you as much as you can. Super valuable thing, for you when you're early and learning so fast all the time. It's not a solo sport. So 92% of angels, I guess, investing via a platform, something that we will definitely cover today, and Ed will be able to bring, some interesting insights into that as well. And then, unfortunately, there are some regulations in the angel space which can slow things down a bit, exclude people or limit the numbers of people that you can have. So it's important to know that there is some regulations that you need to adhere to as a founder and an investor. So yeah, just make sure you're on top of that. A couple of other things just for the next couple of minutes. Really interesting number there. 3.25 million would qualify as a sophisticated investor. That's a really significant pool that as a tech community we can look to bring in and engage and participate in our sector, which is really exciting. Only 2.5 our estimate of active Australian angels, so 2,500 out of 3.25 million. So I think we've got a long way to go as a sector. But at the same time, 2,500 is still quite a lot of people, to be able to reach out to fund your venture. So pretty exciting time to be a founder and to be raising. Looks like 35 to 44. I'm just scraping in there, and I did start angel investing this year. So that's cool. I'm going to jump into that yellow category there, but interesting to me, 25 to 34 is really highly represented. That's pretty cool. I wouldn't have thought that. So that's some interesting insights there as well. 83% are men, so I think we need to try and balance that out a little bit over time as well. And 60% located in New South Wales. So one thing as a founder you might want to think about if you're raising is to increase your Sydney network. And also, of course, we should all try and blend out the involvement as well. But at the same time, if you don't have a Sydney network and you're raising, you're probably going to be making life a bit more difficult for yourself. So anyway, there's a little bit from that report. I highly recommend getting your hands on that. That's Cut Through Ventures and Folklore leading that, but tons of other people were involved, including probably everybody on this call. Our logos are probably all here somewhere. So thanks to all the people on the call for being part of that. Now, let's introduce everyone. So my name's Jason. I'm one of the co-founders of Cake. Cake is a platform for managing startup equity. We do a ton of education work, blogs and guides and workshops right across the Australian ecosystem. And we do mentoring on capital raising quite a bit as well. We partner with all these great people here. So we're excited to be able to help, I guess, share insights on what angel investing is, how to access it in the right way, what are the trends that are going on. So we'll try and bring some current information out for you, to make it easier for you to raise, and not just raise, but raise well, in a good way. So you're building great relationships with your investors and funding your company in the right way through those very early rounds, pre-seed and seed, most likely. So Mel, I might hand over to you. We worked together on the Airtree Explorer Program. I was part of the original gang there. I think you guys are up to cohort 3 now. Do you want to maybe introduce yourself and talk a little bit about what Airtree is up to and what you want to talk about today?
Yes. Yes, very brief self-introduction. So My name is Mellisa Ran. I'm the head of community at Airtree Ventures, one of the largest venture capital funds that invests in Aussie and Kiwi founders. Now, as a venture capital fund, of course, our funds tend to be a lot bigger. Our latest fund is a $700 million fund, and overall we have about 1.3 billion under management. But where a few years ago we saw the report from Crossroads that said in the sort of 3 years prior to 2022, the very early stage angel investing and seed investment dollar amount was actually declining despite the overall sector growing a lot. And so in 2020, we decided to run the Explorer Angel Investing Program, where we bring together some of the bigger superstars in our ecosystem who's contributing a lot to the ecosystem, but who either already are angel investing and want to do more of it, or are aspiring to be angel investors but haven't started yet. So Jason was in our very first pilot cohort, and now we're up to cohort 3, and I have the great privilege of running that. So now we have 150 angel investors in that cohort, and so a lot of what I can share with everyone is my anecdotal experience dealing with this 150 people, and they come from all sorts of backgrounds. So I think a lot of the questions about how do you find them, how do you approach them, what does the nitty-gritty mechanics work, a lot of that will vary depending on who you're dealing with and what your startup is. But yeah, I'm very happy to answer questions on what I've seen.
Great to have you, Mel, and Airtree is such a great supporter of early stage companies, and then backing them heavily as well through the rounds. So I used the Airtree Explorer Program to start off an angel group. We've done 12 investments now in the last year, so it was such a great moment for us on our journey up here on the Gold Coast. So and you've also leaders, I guess, around open source investing as well, with probably Australia's best open source investor list. So if anyone here isn't aware of the open source investor list that Airtree's put together, please Google that. Oh, here it is in the chat.
Yeah, I'll put it in the chat. That's right.
In Australian early stage, it's one of the best resources around. There's other things on their website like open source term sheet and various things. So please get around those. So thanks, Airtree, and Mel, good to have you. Now, Chelsea, again, one of the most prominent and early stage investors in Australia. I'm super keen to hear specifically and for you to share with everybody what Scale's up to, please.
Thanks, Jason. Hi, everyone. So my name's Chelsea. I'm one of the co-CEOs at Scale Investors. Scale Investors is an angel syndicate network that invests in women-led and gender-diverse Australian startups at the pre-seed and seed stage. And I guess we'll go into a bit more about what that means. So our vision here at Scale is one where gender doesn't limit access to capital. Jason, I think you read out a stat there around not only, there's more men investing in this asset class than women, it's the capital is not evenly distributed across, gender diverse teams. So, that's really our goal here at Scale, where we're here to invest, we're here to educate. The biggest piece is getting, more early stage investors looking at, pre-seed and seed deals. And so we provide investor education as well as founder education. Since inception, we've invested in 36 startups. We've added 4 new companies to the portfolio just this year. And as an angel network, through our syndicate, our check sizes start from 100,000. We go right up to 600,000 or 700,000, depending on the syndicate and the interest in the deal. But again, I think I can go into more about that later. A bit on the network, Jason again mentioned, that founder turned funder, that avatar. We've got a bunch of investors in the network that have successfully built and exited their own startups. So they're providing capital and support to our portfolio. And yeah, so I'll probably just leave it there and can go into more detail with questions later, I think.
Awesome. Yeah, I love that. That angel investing is direct and through groups and through syndicates, and it's quite a fluid space. So I'm looking forward to sharing a bit more about that with everyone during the call. Thanks, Chelsea. Now, Ed, I hope you don't mind me sharing that you're a cake investor. So thanks, mate. And we've been working together on various things, and you've been very busy in the last 12, 18 months. I guess everybody should be hitting you up for investment as well. What's your what's going on down there with yourself, and is it Cardinia as well as Galaxy, or how are you sort of what's going on with you, mate?
Yeah, that's a great question. I'm wearing too many hats and I'm trying to simplify it. But yeah, I guess at a high level, so I was a founder. I was one of 3 co-founders of Omni Studio. We started off as this B2C audio app, and we had Angel, we had VC, we had strategics. We even had an ESOP plan that we spent a ton of money with lawyers on because Cake didn't exist, which was pretty upsetting. Anyways, so we went through this journey. We ended up pivoting, and then we had an exit in 2019. Along the way, I started investing. I raised a small VC fund called Cardinia Ventures. We've done about 30 deals, half are in the US, half are in Australia. And we've co-invested, we've run a few cap tables with both Airtree and Scale, which is exciting. And as Jason mentioned, we're on the Cake cap table, which is great. Anyway, I lived in Silicon Valley for a couple of years. I got back to Australia and I kind of realized that all these things that just worked there were kind of, a lot of them were missing here. And so one of the guys from Startup Galaxy, from Omni Studio, we teamed up and made Startup Galaxy, originally first as like a side project. And we just wanted to build tools that kind of help the ecosystem. So we originally launched a founder directory, then we added a jobs board. But I guess now what we've really become known for, I guess, is our investment infrastructure. And so if you've got an angel group or an angel syndicate, or you've got like a small VC fund, we provide kind of, all the software and sometimes even the licensing to kind of just run everything. And Scale use our platform at the moment, which is super exciting. Love working with them. So yeah, have kind of worn a few hats and really keen to talk about all things angel today.
Great, mate. I think we've got an incredibly diverse group of real leaders here. So hopefully we can extract out some very valuable information for everyone. We'll let you guys be the judge of that, but we'll do our best. So I think a good next step might be just to try and compare, say 2018 with 2021 to give people a little bit of a feel for how, the angel space has grown. Mel, I might throw to you first. I think you sort of alluded to this already. How do you see some of the, maybe one or two of the biggest shifts from over the last few years?
I've definitely seen a growing interest to angel invest and for the early stage startup asset class in general. I think just as in Australia, we've had probably 10 years of the renaissance of startups growing to where they are. And then we've had some big unicorns, more and more unicorns coming out, joining Canva at last year. And even in our portfolio, I think we have 7 to 8. And so people are seeing, wow, this is, an area that you could really get outsized returns, and we're supporting the future. So more ordinary Aussies are being turned onto this opportunity, but at the same time, people who have grown up in this ecosystem, they've now are exiting their businesses, and not only are they founders, but they're also growing their team with them as well. So we've definitely seen quite a few. I think probably a good proportion of our Explorer program participants are senior leaders or early employees at startups that have recently exited. And so they're all, feeling very keen to give back and to allocate a part of their wealth that they've created to the angel space. Yeah.
I love that. And just in case, Cake's the best place to make sure all of your team have some equity, so that when you do become a unicorn, more of your team can benefit and bring more angel investors back in. It's never been easier to do. I think 5 years ago it was like $100,000 job to ESOP, and now it's like a couple of grand, and you've got software to help you. So there's really no excuse. So make sure everybody's benefiting as you grow. It's good for everyone. Thanks, Mel. So yeah, Ed, you said you've been in the Valley, and now you're back here, and you've sort of been around the ecosystem for a few years. Have you got one or two things that you would highlight as being the big shifts over the last few years, mate?
Definitely. I think you hit the nail on the head around there are founders having exits, and then also either individual angels or employees who are doing well out of ESOP, or they're selling secondaries, and then all of that money is getting recycled. And so, Scales had some great exits. I know some of the other angel groups have, had some members do some secondaries at kind of Series B, C, and D. And what's great is when that money comes back, because they've seen a win and they've kind of gone through the journey, they're happy to reallocate quite a lot of that like back into the ecosystem, and it really does create this kind of snowball. So that's one we're definitely seeing. I'm also seeing a lot more structure. So, people, using platforms or setting up entities or just doing things that make the whole experience a lot easier for the founders and also the investors. Like very much, a few years ago, it was very much like you'd pitch an angel group, there'd be 20 members, 5 of them might invest, and then you got 5 names on your cap table. Now people are pitching angel groups with like 50 members and 30 of them are investing, and they're doing it in one structure, and it's just super clean and super nice.
I love that. Chelsea, did we cover, what would you add to that, mate?
Yeah, I mean, agreeing with, everything that Ed and Mel have covered. I joined Scale in 2018. I've seen such a shift in the amount of angel investors, not only in Scale, but in the ecosystem since then. There was Brisbane Angels, there was Sydney Angels, there was Melbourne Angels, as sort of the cornerstones, I guess, for each state. Australia is super siloed when it comes to states, and we're really seeing that sort of, especially with COVID, that's breaking down. There's more investors that are cross-pollinating, if you like, across different angel networks. There's new networks emerging. I know here in Victoria, LaunchVic has played, a big role in funding early stage angel groups and getting, more structured groups off the ground, and, just breaking down the barriers. It's really hard to access, high net wealths and angel investors outside of, angel groups if you don't have those existing networks. And so, there's just been such an increase over the last, 3 or 4 years on, angel groups that are out there, and they're pitching to founders, hey, I'm here. I've got a network, we've got money to spend. So yeah, that's a really great shift. And I guess that comes from that founder turned funder sort of flywheel that's, only getting, more exciting and more regular.
I absolutely love that. It's a really good time with the founder turned funder dynamic as well. I think we're seeing a shift in the type of help you can get as well. I think you go back a few years and, there were angel groups and they were great and they had success in whatever businesses they had, but they weren't necessarily tech successful. And so the advice level and type was a bit disconnected to the type that the startups really needed. But that is really, really changing. And having people with 2 to 5 years ahead of you as a founder being able to really give you insights is super valuable. So definitely look for those sort of people if you can get them. I know Cake's got some guns and it's been really, really valuable for us. So cool. All right, so we talked a bit about the trends, perhaps don't want to oversimplify it too much, but a little bit about what angel investing is, just to help sort of set the scene, especially for the newer founders here. It's the hardest part. So let's spend a little bit of time helping just with a bit of Angel 101. So maybe we'll go back in reverse order this time. So Chelsea, with an angel round, would there normally be a lead investor? And how do the rounds sort of come together in your experience? Is there a couple of different types that a round might take, or perhaps one step further? So we're talking about pre-seed and seed here, right? Let's just sort of set the scene. Angels do participate in Series A, but they're normally just trying to like clamber their way into the, or perhaps I shouldn't say that, because angel syndicates now are getting more prominent into those later rounds. But let's say pre-seed and seed. How would it come together? Is there a lead investor or not? And can you do one without one?
Yeah, I mean, look, there's no linear pathway, to raising that first round of capital. Some founders do a pre-seed, some do a seed, some do a family and friends, all these terms and all these specific rounds, it's all kind of jargon at the end of the day. We've just recently done a post-seed round. What is that? Is it a bridging round? Is that a Series A? Who really knows? But getting that first private check-in, from high net wealth or angel investors, it's tough. It's hard slog. And so that question, Jason, around the lead investor, we see founders sort of get tied up in knots because, investors are the worst for it. We say, get a lead investor and, we're good for 200K or whatever it may be. So look, It's great if you've got a lead investor, and what that really comes down to is, someone that is, well versed in your sector, that can, sort of set the bar in terms of the due diligence that needs to be done at the early stage. Because I think, when we're looking at really early stage companies, especially in the pre-seed category, it's not a lot of data. And so if it's a sector that, Scale, for example, doesn't have an industry expert in, we may then say, we would prefer if you had a strategic, lead investor that has, more insights into an already really risky sort of, deal that, given the stage of the business. Do you need to have a lead investor? Like, I think it's, a great signal to get other investors to join around. There's some great, structures that you can raise capital through where you don't necessarily have to negotiate a term sheet and go through that process through an equity round. We see pre-seed rounds in a lot of cases doing a SAFE, which, here I am with jargon again. The acronym is a simple agreement for future equity. And we see that that mechanism gives some power back to founders to sort of lead their own round, especially if you're raising sort of a small amount of capital at the early stage. It's a really simple document, as the name would allude to. Most of the standard templates are available on open source, websites like the Australian Investment Council. Airtree probably has something available, and a document like that and a mechanism like that really puts the power back in the founder's hands around, taking charge and getting those investors to buy in at the very early stage, at the pre-seed stage, where it can be quite difficult to find that sort of elusive lead investor. Again, each individual investor or syndicate that's joining the round should be doing their own due diligence. And I guess, at the early stage, if there's that lead investor, they're really someone that other investors can look to share the due diligence and to, get a deeper understanding of the sector and the deal opportunity. So look, I'm probably contradicting myself a bit there with that answer, but there are many pathways, and there's some great, the SAFE agreement comes out of Y Combinator. It's built for startups, it's built for early stage businesses. Again, it saves the founder a lot of money on, legal negotiations and time, most importantly. So yeah, there's a few pathways.
Yeah, it is certainly not one way through. One way I like to think about it is if you get a lead investor, you probably raise a larger amount, and it can be perhaps more of a milestone round. Whereas if you miss out on that, you can quite often end up with a smaller round, but it can still give you the capital you need to proceed. And the main thing is just to get the funding, some considerable, the funding you need to hit some milestones so you can keep progressing the company, keep momentum going, is key. So I think, Ed, what do you reckon, mate? Any comments on lead versus non-lead, and also perhaps, equity, safe or note? That was going to be my next question. So Chelsea, you were like in sync with me totally there. It's sort of so intertwined, isn't it?
Yeah, great question, Jason. Similar to what you just said before. So we're seeing a lot of founders in this first kind of round where they'd get angels raising anywhere from $100K to $2 million. There's probably a lot doing the kind of 200 to 500, and then a lot of people doing 500 to $1 million. If it's the larger amounts, there's usually a lead. Now, it could be a small VC fund, it could be an angel group or an angel syndicate, it could be a family office. And then once they've kind of got that lead who's done DD, it's quite easy to go out to people and kind of fill the rest of the round. For the founders where they are kind of doing the round themselves, they often, maybe one angel will put their hand up and do the DD, or maybe the startup will just kind of provide a lot of info and then everyone does it. Those rounds are typically smaller, and they're probably a bit harder to pull off because there's a lot more trust in the founders. I've noticed a lot of founders want to do the SAFE, as Chelsea kind of mentioned, because it's great. It's only one thing to sign. You kick pricing down the road. You're basically like, we don't know what it's worth now, so we're going to give people a discount and set a cap and kind of worry about that later. One thing that no one really talks about that I think would be good to kind of surface is on the investor side, we have a ton of investors that all want priced rounds. And the reason they do this is there's this great incentive from the government called ESIC, and it's like early stage innovation company. but you basically get some of your money back at tax time, and then you also get a cap gains discount. And so I've got all these investors on one side saying, hey, I know the safe note's great for the founders, but I'd actually pay a higher price if it was priced, because then I'm going to get my ESIC, and the founder could potentially get the price they were hoping for down the road. And so I think a lot of companies don't even realize that they could qualify for this ESIC kind of program, and either do a lot of investors. And so I think just in the market, there needs to be more awareness of that. I still think safes are probably going to win because founders are driving it, and it's just way easier for them. But I'm definitely seeing more priced rounds because of ESIC at the earlier stage.
I really love that. I think in the UK, safes are almost completely irrelevant. They've created like a separate quasi-safe thing because they've got a very, very strong program, EIS and SEIS, which is sort of the parent of our ESIC program. And yeah, certainly as an investor, getting access to those ESIC benefits are a tremendous advantage. So really interesting point there, mate. Mel, anything from you on, I guess, how you're seeing these rounds come together, pre-seed or seed with regard to, leads or party rounds and things like that?
Yeah, I think totally agree with what everyone's saying. I think a lot of it is, the founder, for your business, for like the stage of your business and what you're trying to accomplish, think about like what's the most ideal situation for you, and all of these different options. It's kind of like you can have the ideal and you try to go for it, and if that didn't work, then you can go, okay, well, try to get one lead. If that lead doesn't work, with the next lead. If not, you might do a smaller round. Whether it's safe or ESIC, it depends on who you're talking to. So I think that the overarching approach is just think about like your business, what you're building, how much money you're going to need, what's the ideal, and then have your plan A, B, C, D. And the final thing that works out is a number of sort of a combination of luck and who you speak.
Yeah, like, as a founder and as a very experienced person in capital raising, I often joke that every raise is totally different. You can never be prepared for your raise. It'll, no matter how experienced you are, it won't go how you think it'll go. And I can't really stress that highly enough. I do advocate preparing a lot because I feel like it massively tips things in your favor, but at the same time, you have to be prepared for a bit of chaos. And then I guess on the lead side of things, for me, it's kind of like, just say you need 10 people to invest based on your average check size and the size of your round. It's hard to get 10 people to agree, right? Because it's just a difficult thing to do. So you're just trying to get one to agree, and then once you have one, it's much easier to get the rest. So whether it does become a party round where it's not really a lead and everybody's kind of investing the same amount, or whether it is like a true lead where they're taking 25 to 50% plus of your round, whatever it is, I think the more you can hone in on the best possible partners for you from an alignment perspective, plus their willingness to invest, and spend your efforts there to get that first one over the line, it certainly does make the rest of your efforts a lot easier. So just that's the really good insights there. I'm sure people benefited a lot. If there's any questions on that topic, please do put them in the chat. I'm going to make sure we allocate 10 minutes at the end for that.
I did want to add to Ed's point. So in terms of the round sizes, right? Even for funds like us, like at Airtree, we have done rounds where we put in 200K. Like that's probably our smallest check size, 200 to 500K. So in those situations, we have joined other angels in what would be like the pre-seed round for a business. So I guess my point is, don't discount some of the bigger funds or other smaller VCs in your when you're trying to contact people, because it's like it is very flexible. Yeah, it could be that you get one institutional with a bigger size check and then have like 10 different angels to fill out the rest. So yeah, it could all happen. So that's why you do have to have a lot of conversations.
Totally. And like it's a strong trend, and all the investors are coming down. Private equity are coming down into Series B, and then ventures coming earlier. And I think you've just announced, was it a $200 million allocation from your new fund for seed?
Yeah, for seed. Yeah, exactly.
So please, definitely be hitting Airtree up. Yes. and don't leave them out. Like 5 years ago, I think it would have been not the case, but you have more opportunity now than ever, and there's more investors than ever. So please make sure.
Over a third of our investments were in companies that doesn't even have a product. Yeah, like or at least pre-revenue. Yeah, pre-revenue, and quite a few pre-product. But
that blows my mind. Like that really blows my mind. I would love to sit on the IC for that. Like there must be some seriously cool chats and debates going on there.
I would say a lot of that kind of scenario would be typically with founders who like either they are, second, third time founders, or, they've sort of proven there's clearly a problem. So they just haven't built it yet, but their industry, their domain expertise makes the team feel very confident that there's something there. Yeah.
Love that. I'm going to now dive into pre-seed versus seed. And if we can touch a little bit on valuation in this, and something you just said there, Mel, struck a nerve with me. And I think sometimes people see all these incredible valuations, and of course we all want those valuations, but there's normally a very unique thing going on there. Like perhaps it is second, third time founder, perhaps it's being spun out of a larger business and already has a ready-made huge pipeline of customers, or like there's normally something that you can't see that isn't, hey, I'm a new founder and I'm like,
exactly,
the nuance off the ground, like. So I think we need to just just be aware of that. But perhaps when we're talking about pre-seed and seed, because there will definitely be both founders on the call, maybe Mel, we'll start with you this time. Do you see there being a difference between how the round could run? If you've done a pre-seed, what should you be thinking about differently with a seed, or do you is there any differences you can think of?
From my own experience, not really, because really it's a label. I think it's very similar to what Chelsea was saying. Like it's really dependent on the business, and if they're sort of pre-product, or if the founders want to position it as even earlier stage, then they might call it something different. But
you'd rather use milestones, perhaps, like I've got these milestones, or these are the strengths I'm bringing, and then how would you then see? Maybe Ed, how would you then see them trying to set a valuation for that round? So you're coming in, you don't really want to call your round anything anymore because it is pretty tricky and we're just running around, and these are our goals and these are our spending needs. And how would you go about, because I always advocate in that last bit before you're really raising, just do your research, have some good discussions, get good feedback on your deck and how much you're raising, and is it the kind of the right amount based on what investors kind of see you, how they see you. Have you got any insights on that, Ed?
Yeah, sure. So echoing what everyone else said around, I just tell people that they're doing a funding round, because what the labels mean seems to be different to other people, and you don't want to spook anyone off. So I always look at it as you've got your startup, you've got, the traction you've got, you want to raise for, to have a minimum of 12 months runway, hopefully 18, sometimes as high as 24. So let's say it's like 18 months. Come up with a budget that, a number you need that's going to help you kind of, as you said, put some fuel in the tank and really hit some milestones. And then what I love is when the founder talks to me and says, hey, we're raising 500K, that's going to give us 18 months of runway. And we think in 12 months, we can hit milestone A, B, and C. And then if I think of that, I think, wow, okay, if they do those things, then of course they're going to be able to do a really good round at that point. And then that I see that kind of journey and they're thinking forward, and that kind of makes me want to invest. Now, I've seen some people just say, hey, this is the price, and kind of go and test the market. If it works, it's great. If it doesn't work, they can definitely spook some people if it's too high. A lot of funds I know, or angels, prefer when people come to them with just the amount, and then they'll kind of come back to them with what they think the price should be. And then sometimes the investor's gone, hey, well, what if instead of 500K you had $1 million, or 1.5? And then I've seen it definitely go up. I haven't seen it go down as much. I think another one is I'll meet founders where they come up with their price and they go and meet the top 5 investors for their business, and they kind of almost burn those leads. So you want to really come up with, as Jason said, do your research, come up with who would be your best investors, go test the waters on other people first, go talk to some similar startups and find out, what their value was, or other people in your industry. So you've got some data you can kind of push for. And then I think the biggest one is just creating some FOMO. If the founders that kind of run their own process, where they say, hey, we're going to market here, we've got this long, we're taking meetings, and they kind of send good updates to all the investors. I see those and I'm like, oh no, I'm part of a process here. They're talking to all these other people. I better be quick to respond. It really, really lets the founder drive. So lots to digest there. Sorry.
That's great. A few key points there. Certainly don't necessarily need to name your round. Do your investor homework. Don't burn all your credit with your favorite investors up front, and also run your process really strongly. I've got three. If you go onto our website, or hopefully Gabby can put it in the chat here, we've got a capital raising toolkit that we designed, and we've talked to heaps of people around Australia, from VCs to lawyers and accountants and founders, and tried to put the best resource we can together. The preparation phase is distinct from the marketing phase. The marketing phase, you have to be really ready to do that when you do it, because if you don't, it's all wishy-washy and you can't, communicate strongly enough. There's no timeframes, and then it just drags on and you lose all the energy from your round. So, you need to run that phase separately. And then once you get your term sheet or your lead investor, or you finally get someone to say yes or whatever, if you're running a party round, then you can go into the closing phase after that. So Gabby will share that resource. It will help. There's a preparation checklist in there. And look, if Ed or Mel or Chelsea want to comment on that and help me improve it as well, I'll be grateful. But for today, I might move us along onto, what do we got? So any angel red flags, Chelsea? So that's a bit of a tough one to send to you straight up. If you want to pass, feel free. But I've got a few things, the right types of questions to ask, the right way to go about the process so that you make sure that you're getting the right investors. Would you be happy to field that one? How to help our founders, I guess, avoid just working with investors that are probably not going to be good for them?
Yeah, I mean, do your due diligence on investors. Talk to other companies that they've invested in. Scale, we list all of our investments on our website. Most other groups have at least a portion of their existing investments on their website. Ask for with syndicates especially, ask for, maybe warm intros to someone that you think might be able to support you, beyond capital in the investor network. Get to know individuals as much as, investors are, trying to get to know you and your business. Post investment, just keep the communication lines open. That's sort of all we ask. If a founder is retreating and not reporting, not communicating, not asking for support, we're probably not going to provide follow-on capital. We will invest at the early stage. We will take a risk, but we expect that the relationship remains open throughout those very tough early days. And in most cases, it can just be as simple as a monthly email: the good, the bad, the ugly. Can you help me with X, Y, and Z? Be really specific. Angels love to be asked, to help. So, building those relationships post-investment is just as important as pre-investment, because you want to be thinking about that next check. You're potentially going to have to raise money again in 12 to 18 months. Angel investors are there to support for 1 or 2 rounds. Whilst you're in that process, start to get to know other investors, create a distribution list, ask your angel investors, if they can help with intros into VCs, at the very early stage as well. The more that founders are asking us, to support them outside of capital, I think that's a really great sign. And something that we try to encourage founders to do, because if you don't ask, you don't get. I guess, yeah, that's sort of where we're at.
Yep. Awesome. Couple of things from me on that as well. So yeah, just doing your homework. I think you started with that as well. So if you're talking to an investor and they're doing one investment a year, just be aware, are you investing? How many times have you invested? What industry are you investing in? Do you invest in the stage of the company that I'm at? You have to ask those questions right up front, just to get to know people. I think investing is much more of a matchmaking process than founders quite often really understand. And don't get upset if people say no. There's so many reasons why they could say no. And that's why, unfortunately, it's this big, like an enterprise sales process where you have to have a very big net at the top, and then you work your way through. Ideally, you'll find your investor early on, or you might strike up a really good relationship really early on and circumvent a lot of that work. But if you don't actually have a wide enough net early on, you can find your raise just takes forever, and you end up getting really emotional about getting a no and things like that. But there can be so many reasons why that's happened. So I think just being careful as a founder with your time, and that you're asking the right questions, and that you're trying to get ongoing discussions with the right people that are there to support you and have the capacity to support you with time and resources and funds is really, really important. It's actually quite often the founder making the error and then blaming the investors if they aren't investing, not to like hassle founders at all, but it is a part of the learning process that I think is quite important. So, all right, so lots to unpack. We've got about 10 minutes before we'll check out some questions from the crew today. So let's go on to preparing a little. We've talked about some preparation stuff already, of course. Mel, maybe from you, have you got any thoughts on some of the top things that our founders can do when preparing to run one of these early stage rounds?
So I actually can jump on the previous point. I think we're talking about like the red flags that founders might feel with angel investors. I think one thing that's really important is understand that it's a long-term relationship. And so finding people that you feel understands, like, on the same wavelength with the right expectations. So with some angel investors, it might be that you're wanting them to be a lot more proactive in terms of, maybe they've had industry experience exactly what you're looking for. So you might want them to be, checking in with you every, quarter, every fortnight, and then maybe you even want them to sit on your board, for example. But with other angel investors, it might be that they feel like they want to be very active and very in your face, but you feel like mostly I just need your money right now, and so
imagine as a founder you were getting 30 calls, or like hopefully the cap table's not that big, but it can be by the time you like get to Series A, getting 30 calls every week, and you've got 30 emails. And similarly for an investor, if they've got like 40 investments, they really can only help hands-on like a small amount, so I think this is a misunderstanding that's very common, I think, in the beginning, until you learn that dynamic. If they don't all want to be there with you every day, you probably want a few of them there, and to get that balance right is really important. Great point, man.
Especially if they're new angel. I was going to say, especially if they're new angel investors, some of them might be like really excited and want to be really active, but you might not actually want that. So just making sure that there's that expectation, match there. And then in terms of preparation, I think I completely agree with what Ed was saying. Right, do your research in terms of what's your like ideal hit list of people, and a lot of it is do look at founders or ex-founders or successful professionals that's active and high profile in your industry, right? I'm sure we'll all have our ideal lists, but then maybe before you approach your most ideal person, practice your pitch, get a good sense of exactly what you're going in with people that's lower down the list.
For me, I think networking is massive. So if you're not involved in one of the many major startup networks, get in there, get in multiple of them. I think something that a couple of you said is really important: build a founder network as well as an investor network. Who are you going to ask what their valuation was? Who are you going to ask? And early on, I had no idea how to find out a valuation. I still find it very difficult, although information is certainly surfacing a little bit better than it was a few years ago, and I got a really good network, so I can ring people and stuff now. But in the beginning, you don't even know how to even peg yourself from a val perspective, and am I pre-seed and seed, and so I think build a founder network, build your investor network, build your relationships, and just keep that going is a big one. There is a preparation checklist in that toolkit that Gabby or Cal have shared there. So there is a checklist there that we've put together. One of those things is like a pitch deck. So I would normally advocate a short, very high level pitch deck, which is kind of the intro to get your meetings. And then you have a more detailed pitch deck that you would normally present to and provide after the meeting for that first little bit of, more detailed exploration between yourself and the investor. Ed, how do you sort of see that pitch deck process? How would you put that together? What do you like seeing as an investor when it comes to pitch decks? What should be in there? What shouldn't be in there? Should we maybe jam on that a little bit and help the guys out with what we think the investors like to see?
Yeah, definitely. One quick one I just want to add to that kind of piece you were talking about before, just quickly, is what I'm seeing more in market as well is people spend a lot of time on, it was kind of mentioned, but on really small checks. And so if you're a founder and you've only got so much time for your raise, don't spend it on the people that are going to do the 5 or 10K check. And so one of the things we've been seeing at Startup Galaxy is the founders basically go, okay, we're raising $1 million. If you're going to be more than 50K or 100K, you can be in the cap table and we'll give you a lot of time. But if you're going to be 5, 10, 25K, then we're going to roll you up into a structure. And we've done that for quite a few founders where, they've used us for the roll up bit, and then they've used Cake to kind of handle everyone else. On that pitch deck piece, I kind of think of it as you've got this problem, then you're going to talk about your solution. Then you're going to talk about how there's kind of a really big market for it and lots of people kind of have this problem and how your solution fits in. Then you're going to have the business model. Then you're going to have the traction you've got. Then you've got your team that's going to kind of deliver this. And then finally, you've got the ask, are we recruiting, or is it, are we after customers? But usually it's, we're raising money. Each of those sections could be one or more slides. I'm kind of seeing anywhere from 12 to 20 slides at the moment, sometimes as high as 25. And so a really good exercise is to kind of start off with those headings and just put some content down. And then what people usually do is they turn each of the headings into what we call like an active heading, where it's like, what is the point of this? Like, for traction, it might be that, we've secured our first 4 customers, or, there'll be kind of like a key point. And then once you've kind of got that rough content, start to kind of socialize it with a few folks. And then from there, actually do the design bit. And look, it doesn't need to be the Sistine Chapel, but at the same time, it should still, if you plug into Canva or get a PowerPoint template or something, it can be pretty good. And then start to socialize it with those other founders, with some investors that aren't at the top of your list. And then, that's how you kind of get your deck ready.
I love that. I want founders to picture that an investor's on their mobile, which they possibly are, and they're flicking through 10, 12 pages and the headings. If they just read the headings, would they get everything they need to get, and then the rest is probably just images or
love that. Yep.
The right graphs or whatever you can provide. Big important things. Just if they're flicking through and they're like, well, like it's in my, they can quickly say, all right, is this too early for me? Is it too late? Is it in the space I am or not? And then I always say, try and get them to ask you questions as well. Like if they come back with questions, then you've probably given them an interesting enough deck and you started that ongoing dialogue. That's really important. Thanks, Ed. Anyone else want to jump into decks and pitching and content and things like that that you want to see in a deck or that you think is important?
So I think one thing that might get overlooked is at the very early stages, the investment is really resting on what the investor feels about the team and the founders and how likely they are going to succeed. So no matter which slide it is and which element you're addressing, I would think underlyingly understand that you're selling yourself and your fit for this. So the team slides is where you could really showcase exactly who you are. But every other slide, like the problem, what is your connection to the problem? Why are you the best person to solve the problem? You think the market is XYZ. Why? Like do you have some experience where that gives you that extra confidence? So every slide is a showcase of your ability, your extraordinary ability as a visionary and as a founder. Just like a job interview, every single interaction is actually an opportunity to sell yourself.
I love that. Yeah, when I present on capital raising, I've got this slide, which is like, where are you going? Like if you aren't super powerful, there isn't something about you, something about your mission, something about your company that is really, really compelling and you can't articulate it really well, the whole capital raising process early on is going to be much, much more difficult. So if you're not sure about that, like we were saying before, get a coach, talk to people that you trust, talk to advisors, bring that out and make it really central to your pitch. Awesome. Good point. And maybe we'll jam on this for a few more minutes if people have more on this, and then I might hit a few of these questions up.
Yeah, I guess I would just say, building on what you said, Jason, we see hundreds of decks, every year, really make yourself stand out. What's your story? Angel investors love to get to know you. Like Mel said, we're investing in you as the founder. You're the person that's going to deliver on this vision and this mission. And, telling the story in a super articulate way, through your numbers, through your financial model. A lot of investors tend to go straight to numbers, even if, they're, only just forecasts at this point in time. But, how do you tell your story to investors through the numbers? How does your business make money? You'll be so surprised how many pitch decks and founders I chat to, and I'm like, well, what are you actually selling here? We want to understand that there is a product here that you will make money. You don't have to be making loads of money right now, but how will it grow? And in turn, how will this generate a potential return long term down the track, obviously. But yeah, just getting that point across around, you know, how you will sell your story and your mission to make money is a big one, which gets overlooked more often than you would think sometimes.
Totally. I think the purpose and mission alignment and the belief in the team is super critical, but I think also founders need to understand that they're not selling their product, they're selling their company, and they're selling their equity, and they're selling return as well. And it can be difficult for especially early founders to understand how to talk about that return. And for me, I like to talk about 2 time horizons. You sort of got your 12-month time horizon, and then you've got your sort of 10 to 20-year time horizon. And that for me has helped me. And I think it helps founders understand how to articulate, look, we don't know everything, but we're going over here and it's awesome. And right now we're going to deliver these things that are really tangible. Would that make sense to you guys? And you got anything to add on those 2 time horizons and how helpful and how perhaps that can be articulated?
Yeah, I guess I'll jump in. I love that. I call it a where we're headed slide, and I usually put it as like probably in the last 3 or potentially before the team slide. And so it's, you know, right, yeah, as you said, like here's the milestones next 12 to 18 months. But, you know, as we progress ahead in 10 years, you know, everyone's going to be doing, or not everyone, but a lot of people are going to be doing these activities, and the market's going to be bigger, and these things are going to kind of happen. And so, you know, applying that back to those angel numbers you mentioned at the start, like, you know, it's clear that if the sector keeps growing and then more tools come along and more angel groups have exits, and more people get equity, and then, you know, have exits and can participate, those numbers could be like, you know, instead of being out of the 3 million, only a few, it could be like, you know, 30%. And so just seeing things like that and just being able to like tie it all together is so key to the investor, because, you know, often the investors never spent as much time thinking about your industry or this problem as you. And so that's part of like taking them on that journey. And it's just a really powerful slide to see, you know, what the founding team think, you know, this could end up doing if the train really like leaves the station and takes off.
Okay, let's hit a few of these questions up. We're getting into the question zone. I really, really hope we've helped you all as much as we can. We definitely tried to hit a few of the most important things. Vincent, love when people ask questions. So thanks for helping and being first, gold star. 2 questions. So is it frowned upon if a founder takes a salary after the first raise? Anyone want to take that one?
No, in my experience, no. Not at all. If anything, we need to know that, you know, the founder is committed and that it's going to be sustainable, especially now when salaries have really, you know, gone up and we got inflation.
Cost of living is very high. Perhaps after the first round, it's a more, you know, modest salary, something that you can live on.
Yeah.
And once you
Yes.
raise.
Yeah, I mean, not crazy corporate salary, but enough that we feel like, okay, this is a good amount that this founder can live on and be able to sustain themselves in this business long term.
The stress is very real, so everybody wants them to be working in a state of focus as opposed to fight or flight. So yeah. And then as a sole founder, would it be preferable to find a co-founder prior to seeking a raise? Let's say that in 2 cases. So this particular question is the company's already profitable. Having a profitable startup is a slight oxymoron to me, but let's just say, what about getting a co-founder for a round in general? I don't think being profitable or not is really relevant, but how do you guys see the single founder, 2-3 co-founder situation when raising?
I'll jump in. I've backed a few sole founders. It's definitely a lot harder journey because you don't have other people around you that've got that same level of skin in the game. So it is, you know, preferable to have a co-founder. The ones I've seen that have made it work as a sole founder do have a kind of really great number 2 that they've usually brought on in terms of senior management, and they don't have founder equity, but they've usually got pretty great ESOP. And because, like, you know, if I'm the investor and one person, it's just one founder and they decide they want to throw in the towel, then the business kind of falls over. Whereas if there's like 2 or 3 co-founders, you know, it can still carry on. Or if someone's away for a bit or something, it's just a lot safer bet. on the flip side, you got to be so careful about finding the right co-founder, and it's so hard. And if someone's on the hunt for that, definitely do your diligence, get to know them, because introducing the wrong co-founder into the business, it can set you back even more and just cause like so many problems. And so
founder vesting, right? So I think all founders should have founder vesting, wherever there's multiple, 3 or 4 years. There's lots of reasons why founders break up. So vesting agreement's very simple, or you can put it in the ESOP if they can fit in the ESOP. With founders, it's only up to 10% to get the tax breaks. Especially if you're bringing in an external founder that you don't know, you have to have a vesting agreement or build it into the shareholders agreement. Quick one for Tam. If you've raised a friends and family, you definitely can do a SAFE for the next round. I think, there's definitely pros and cons for SAFEs and equity and notes, but you definitely can do that. So I'll just quickly tick that one off. We've only got 4 minutes left, so I'm just gonna jump into Annette. So Annette says, price and equity and ARR is now considered early stage, angel levels, seed these days. I feel like it keeps changing. Yeah, so like valuations change all the time. The milestones that you need to hit change all the time. Unfortunately, it's just the way it is. There's been a really big upswing the last few years. This year seems to be like a little bit of a normalization, perhaps even, becoming a little bit more challenging when it comes to milestones and valuations and amounts that are raising. So I think, yes, and it unfortunately is changing all the time. That's why you need to have good advisors, good founder network, be involved in accelerators and ask investors. So unfortunately, it is very much a manual process. You've got to get out there and do that research. At Cape, we have a lot of this information. So if you want to ask us directly, we can sort of help you, like not with advice, but just with some data. To help you on that journey. There are different milestones, but if you want to raise 1 million or 5 million or 10 million, there's definitely significantly bigger different milestones and different dynamics as well, because the later you are, there's more capital as well, which gives a bit of a valuation uplift. So there's so many dynamics, unfortunately, that you need to get across. Can't really fix that one, sorry. Can you share some valuation models for startups for small business? So there is a valuation model in the toolkit that we provided in the link. We use we give you 4 different methods there. The Berkus method, like a sort of a rough rule of thummy type method. There's a revenue multiple method, and there's like a discounted future value method. So those are 4 very commonly used methods, and you could do a weighted average. But quite often it's just more about what the market will give you at the end of the day. But it's good to have a little bit of research done and to go through that process so you're kind of comfortable. Anyone else want to comment on valuation processes and how you would go about that one?
I think something that a lot of people don't talk about is just momentum. And so I get asked often, or people say like, oh, well, this other business here, we're similar to them and they got this valuation, so we should get that as well. And what, in some instances, I've seen that deck, and what they're kind of missing is that the company's growth rate or retention or just some of the key stats that aren't kind of shared publicly are just really strong. And so I think when you're factoring in the valuation, obviously it's the team and the size of the opportunity and what your milestones are, but that velocity of your kind of key metrics is super important. And the other one that I've seen is people say, if someone's willing to walk through glass, like walk on glass to use your product, then that's like really exciting. And so sometimes I see these businesses where they've got like only 2 or 3 customers, but the product hardly works, but the customer's getting tremendous value from it. That's always exciting me more than, say, the product that's, got all the bells and whistles and still has, only so retention. And so there's a lot of factors you can't always see. And so really look at those for your business.
Maybe that's a great way to wrap up. Maybe Mel, what's the most exciting thing, for you, and that you think, from an angel perspective, that a founder can, a few things that a founder can bring to the table when they're raising one of these early rounds?
Oh, it's just you as a visionary. Like the best founders I've spoken to is after I've just listened to them, I think, my God, I want to quit my job and work for you, or this is so cool. So yeah, that's really that sense of excitement, whatever it is that you're doing, making other people feel like, wow, this is this is an unbelievable person, extraordinary person doing an extraordinary thing, and they want to be on that rocket ship, you know.
I'm so lucky to work with so many of these people, as I know
Yeah.
all the points there are. It's like the absolute best place to be. And we thank all you founders bringing your energy in and letting us be part of the journey. Chelsea, anything that you would want to finish with? We're right on 1 o'clock. What would you say is like, you know, the most exciting thing for you when when a founder's bringing something to the table around getting one of these early rounds done?
Yeah, I mean, look, my co-CEO, Samara, and I, we always say like, oh, we're not saving lives, but, you know, our portfolio is, and that's what really gets us, you know, excited and out of bed. Like, even if you're changing someone's life by saving them 10 minutes in their day with a SaaS product, like, you know, you're changing someone's life. So, you know, we meet like Mel, we meet so many founders.
Like paperwork, let's get rid of it.
So yeah, like, you know, we're investing in, you know, exceptional founders, and there's so many of you guys out there. So just like keep going and, you know, reach out if you've got questions. You know, we love chatting to founders. It's our, you know, it's our favorite thing. So yeah, the more we can invest at the early stage, the better for the ecosystem. So we're all here for it.
I love it. So grateful to work with you all and be partnered with you all and be part of the ecosystem. There's never been a better time to be a founder, to be an innovator. You know, there's just so much opportunity for us. The Australian ecosystem's absolutely pumping. So we really hope we've helped today. We've tried to bring the best information we can, but we all have a lot more resources if you engage with any of Airtree, Galaxy, Scale, or Cake. There's tons of information we can provide. So please do come and see us. You know, we're all able to help you in our various ways. So make sure you do that. And thanks for joining us. Thanks to the panel. I think I'll wrap there. Gabby, we're 2 minutes over. Do you need to say good day or anything? Or are we good?
Good day, everyone. Bye.
Bye. Bye.
Take care. Bye, guys.